Hello, everyone, and welcome to another opportunity by Impact Self-Storage, where we provide access to tax-advantaged self-storage investments with an emphasis on wealth growth and downside mitigation. So let's go ahead and get right into it. So the agenda will be about 15 to 20 minutes. We'll cover the team, why now, and the big idea. Then we'll go into the numbers and the secret sauce. Then we'll cover the offering itself. And then last but not least, we'll make sure that we're a good fit for one another. So here's the team. Impact Self-Storage has done about $100 million in self-storage transactions the last 3 years. We have 18 facilities across 10 states and about 60 years combined real estate experience amongst the four of us. We're extremely excited to be partnering with LCI Development Partners and Leopardo Construction on this joint venture. And representing LCI is Chad Broderick. Now, this company is absolutely amazing. They've done $6.5 billion in construction. 75 million square feet built to date, and they run at roughly 650 projects per year. So big hitters in the industry for sure. So why now? Well, there's three changing market forces that are creating a short window of opportunity. So if we act now, we could take advantage of this short window. The first is the changing economic forces. As we know, self-storage is a very recession resilient asset class. If you look at the global financial crisis, 2007 to 2009, the S&P lost about 22% of its value, whereas self-storage maintained at about a 3 to 3.8% loss. Now, fast forward to the most recent financial crisis, which is the COVID pandemic. And according to TREP, a commercial mortgage-backed securities research firm, of the 1,700 CMBS loans that were made to self-storage investors, in the first 3 quarters of the pandemic, only 3 were delinquent. That is a 0.17% delinquency rate. During that same time, multifamily was defaulting at a rate of 1,800% higher, or 18 times the default rate of self-storage. The second piece is that the stock market is overvalued and over-leveraged. The last 2 times we saw stock market price earnings ratios this high with this level of investor leverage was right before the 2001 dot-com bust and then the 2008 financial crisis. And then, of course, interest rates are at an all-time low for now. The Fed has already signaled 3 rate hikes for the coming year. In addition to that, inflation is at all-time highs. The most recent report came out at about 7% inflation if you look at the CPI. Now, if you look at the 1980 function to calculate CPI before they started manipulating it, we're actually experiencing 10 to 15% inflation at the moment. So if you're sitting in cash, that's a losing proposition. The second is the changing technological forces that we're experiencing. Customers, especially the younger generations, want to handle their storage needs online and with less human interaction. They want a more seamless experience. And finally, the technology has evolved to the point where it is financially feasible and streamlined for our use. As you can see in the photo here on the right, that's what an automated office looks like. That kiosk, you can rent your unit, you can buy your lock in that store, you can go to the map to see where your unit is. And if you have trouble with any of these pieces, you can click a button and a 2-way video call connects you with somebody at our call center. And the last piece is the changing social forces that we're experiencing. Prior to the pandemic, big box retail was going for 50 to $100 a foot. Now we're being able to pick these things up pennies on the dollar. We're looking at 10, 15, maybe $20 a foot to buy these envelopes. The second piece is the pandemic's effects on living situations. We've seen this K-shaped recovery. The people on the upper leg of the K did pretty well. They started moving out of cities into nicer homes, with a little bit more space. They had a home office so they can work virtually. They had an extra room for their kids so that they can go to school virtually. That movement is causing a lot of demand for storage. The second piece is that lower leg that did not fare so well, especially now with eviction moratoriums and foreclosure moratoriums expiring. A lot of those individuals are going to have to use storage as they downsize. And then demand in storage has been growing. 1 in 10 households use storage, and that number is rising year over year. The 2 main drivers of this are the 2 largest generations, the baby boomers and the millennials. The boomers are downsizing. They're going from empty nested homes down to maybe small condos or assisted living facilities. And millennials are opting for less square footage so that they can be closer to the action, to the restaurants and the nightlife, and then using a storage closet almost like as an external closet for them. And as you can see, over the last 30 years, storage has outperformed any other sector that you can invest your money in. S&P 500 at about 7.5%, multifamily a little bit better at 13.3%, and then self-storage at 17.4%. That 4% may not seem like a lot, but if you had $100,000 to invest 30 years ago, here's what the values would look like in each of these asset classes. So the S&P 500 would give you about a $500,000 return. Apartment buildings would do a little bit better at $1.7 million in return, but look at that 4% compounding, what it does to your return in self-storage. That 100,000 turns into about a little over $4 million. So twice the return of multifamily with half the amount of risk. So what's the big idea? Well, the big idea is to capitalize on the downfall of big box retail, scoop up fantastic deals, and then convert them into Class A climate controlled self-storage. This allows us to drop our total project costs by over 30 to 50% while delivering the same caliber of storage that the real estate investment trusts and private equity firms are looking for. So let's talk about the project that we're looking at right now. It's in Brownsville, Texas. This is a facility that was at one point in time a Walmart that was converted into Class A storage. We're actually picking up this facility at the cost to construct it. It's a really good deal. And then what we're doing is we're going to expand onto the parking area to double the square footage of the facility, or over double the square footage of that facility. So here's what it looks like from above. In the top left-hand corner, you can see that expansion opportunity area surrounded by a lot of action. And what I want to point your eyes to is that gold star in the lower right-hand side. That gold star is Starbase, Texas, the town that Elon Musk created for the SpaceX launch site. And so SpaceX has been very big on Brownsville. They've been really beefing up the investment into the area, not only in personnel, population growth, job growth, but also in monetary dollar investment as well. So here, as you can see, Elon Musk actually gave Brownsville $30 million without even telling them that the money was coming. And as you can see in this tweet here that he sent out, I'm donating $20 million to Cameron County schools and another $10 million to the city of Brownsville for the downtown revitalization. And then here are some of the details that followed. Please consider moving to Starbase. We're hiring engineers, technicians, and builders, as well as essential support personnel of all kind, and the area is going to be rapidly growing. Starbase will grow by several thousand people over the next year or two. So that's going to drive a ton of demand for this area. So let's go ahead and look at the market demographics. So you're looking at the 5 mile trade area. There's about 130,000 people. And the key metric to look at is the ratio of rental units to total housing units. Typically, we like to see 20 to 25% plus. But as you can see here, we're closer to like 50% in the Brownsville market. So that's very good. And then the second piece, as I alluded to earlier, was the generational makeup. You can see that the baby boomers account for about 23% of the area in Brownsville. And then the Gen Z and the millennials account for another 57%. So a lot of need for storage in the market. So who's a good fit for this investment? Well, investors needing to double their money in 5 years or less, who are dissatisfied with volatile investments such as stocks or rapidly depreciating assets such as cash. The Brownsville storage offering is a project that is recession resilient in a market that is severely underserved. And I'll touch on that in a second here. And unlike most development projects, Brownsville storage is already cash flowing with expansion and allows for multiple exit strategies to mitigate downside risk. So let's break that apart a little bit here. So here's the project timeline. We'll be buying the facility and then starting construction immediately to double the square footage. The property is going to break even around month 17 and will be stabilized at 90% occupancy around month 30 with a projected sale in month 48. Now, the reason I say projected sale in month 48 is that we have projects recently that have been closing much faster than projections. We just closed on one in Mokina, Illinois, where we closed 4 years ahead of schedule above our 5-year sales price. And that's because of all of the dynamics that are going on in the market. A lot of these larger firms are sitting on a bunch of cash. They don't want to lose that money to inflation. They don't want to deal with the supply chain issues of construction and rising costs of construction. So they'd rather just buy a brand new built facility from us at the stabilized valuation. So let's look at an overview of the project here. It's a Walmart conversion. It's going to be the premier Class A storage facility in the area. It's currently 55,000 square feet with about 418 units, but we're going to be doubling that square footage to about 118,000 net rentable with about 912 units total. It's got a strong trailing lease up. There's 175,000 net rentable square feet of unmet demand in the market. This was corroborated by our third-party feasibility study expert, Bob Copper, over at Storage 101. And to further support that fact, all but one of the competitors in the market are at 100% occupancy with waitlists. The only one that's not at 100% is because they have a second floor that has it has a lot of 5x5 units, which are not very popular in this market. People want the 10x10s, the 10x20s, the 10x40s. Currently, the building that we're buying is at 84% occupancy, which is just a fantastic number based on the way that we're buying it currently, which I'll talk about here in a second. And like I said, it's home of the SpaceX Launch Facility, dubbed Starbase Texas. So let's go over the numbers. These are super high level details. This usually puts people to sleep here. So if you're a good fit, an in-depth analysis and due diligence will be provided in the Invest Next investor portal for you to go through with a fine tooth comb. So let's just go through this really quick. First, we're getting a bank loan for about $9 million. We're bringing about $3 million of equity to the project. It's going to put us at about a $12 million project cost with a projected sale price of $16.3 million. And I'll show you how we got to that. The current facility has a revenue of about 450, operating expense about 200, and a net operating income about 250. But the key piece is that we're buying it at $61 a foot. That's cheaper than it costs to construct the building. So we're buying basically a stabilized asset for the cost of an empty one. Once we stabilize the facility, it'll be operating at about a $1.5 million total revenue number, about half a million dollars in operating expenses, and then a net operating income of just shy of $1 million. So at a 6% cap rate, which is pretty conservative in this market, we're projecting a sale of about 16.3%. Now, we've had other sales that we've exited at lower cap rates. So you can see the matrix here to see if we get into the 5.5 or a 5%, we may be into the 17 or $18 million sales mark. So what is the secret sauce here at Impact Self Storage? Well, it's pretty simple. Number one, we want to make sure that we set up our investments so they're tax advantaged to reduce your annual tax burden. Two, we always look for multiple exit strategies to mitigate downside risk. We're always ready to sell if the proper offer comes through. This development is cash flowing right out the gate to mitigate downside risk. The cash flow will cover all of the debt service, or the majority of the debt service for the construction. And then we're going to double your money in 5 years or less. Most likely it's going to be less, but these offerings are set up as 5-year deals. So let's look at the offering officially. So first, for every dollar you invest, you'll get depreciation of 14 cents on every dollar in 2022 and 12 cents on every dollar in 2023. Now, there is a good chance that we'll get certificate of occupancy in 2022. So we'll be able to pull the entire 26 cents of depreciation on every dollar in 2022. The second is that there's an 8% preferred return to our investors. So our investors get paid first before the general partners do. That's going to equate to about a 20.7% targeted IRR and a 2.05 times equity multiple. So let's go ahead and see what that looks like in table format. Let's say you had $500,000 to invest. That $500,000 would give a tax offset of about $132,000. All distributions would be a little over $1 million. Subtract your return of capital of that $500,000, and that means that your net proceeds would be $525,000 off of the $500 that you invested for a 2.05 times equity multiple. So, are we a good fit for each other? This is the most important piece for us. Number one, do our core values align? Our core values are pretty simple. It's FIDO, fun, integrity, drive, and others first. Integrity, do what you say, when you say you're going to do it, even when no one's watching. Drive, it's okay to burn the candle on both ends. And then O, which is the most important piece, is others first, making sure that we're putting our investors first, and then also those in our local community as well. Number 2, this is for accredited investors only. This is a 506C syndication, 506 Charlie, which means you have to be accredited. $200,000 a year for the last 2 years, or $300,000 a year for the last 2 years if you're married, or a net worth of $1 million, excluding your primary residence. The opportunity in the market will be short-lived, so you're going to have to be able to act fast. Most of our syndications fill up within 1 to 2 weeks. So I'll need a decision from you in the next 10 days. And it is 100% okay to say no. I just need to hear you say no, so I don't reserve your spot for someone else that actually wants to come in and invest in the deal. So next steps are email me at fernando@impactselfstorage.com, and I'll give you access to the investor portal. Number 2, perform all your due diligence and seek advisors. Number 3, this piece is very important. You need to complete the subscription booklet. You need to fill out your W-9. You got to review the wire information or attach your bank account through our third-party service, Plaid, which we don't see any of your financial information, just makes it easier so you can avoid wire fees. And then you have to send the accreditation verification. We are a first come, first serve company. So it's based on whose wire hits the bank account first. That's who gets their slot saved for them. And then we're going to need you to wire those funds in the next 10 days. So if you have any questions, feel free to reach out to me. You have my cell phone, you have my phone, you have my email address. I'm around. And then, of course, my attorneys would not be happy with me if I didn't put up this disclaimer. This is a syndication. There are risks that come with investing in equities. Well, thank you very much. And if you guys have any questions, feel free to reach out.